So typically, anytime we're talking about risk, I use the analogy as it's how fast you're getting to your financial goals. So the riskier you are, the faster you're going to get to your goals. But think of it being in a car. Now you're driving 120 miles per hour. Mm-hmm. Every little bump in the road, you're going to be flying through the roof, right?
Yeah.
There's a lot of ups and downs there. The slower you're driving on that bumpy road, obviously you're going to take a lot longer to get to your goals, but it's going to be a much smoother ride.
Hi, this is Becky McCully, your Charlotte Realtor. And today I am here with TJ Faber, who is a financial planner in the Charlotte market. And, one of the things I try to do for all my friends and neighbors here in Charlotte is bring them not just the best real estate resources, but the best resources in general in the area. So, TJ, why don't you introduce yourself and tell us a little bit about yourself and your background?
Yeah, so I'm TJ Faber. I'm a local certified financial planner and financial advisor here. I've been in the industry for a little over 8 years now. Graduated with a degree in finance from Penn State University, and my office is with a fully independent firm called Blackbridge Financial.
Okay, cool. So what is the difference between a certified financial planner and a financial advisor?
Yes, so it's a great question. So the financial advisor, and it's a tough question to answer nowadays, because financial advisor, the title has become such a broad term that it can mean several different things depending on who you're actually speaking with at the time. So in general sense, a financial advisor can be anybody that's providing some level of financial advice. So whether that be determining which type of an account to open up, which type of portfolio you should be invested in, how much money to save each month. Anything in the world of financial advice is typically what a financial advisor is.
Okay.
What you brought up was the word financial planner, and what a financial planner is essentially it's typically a type of financial advisor. This person is going to be specializing in financial planning, so they're going to be looking at everything, right? They're going to be looking at everything that's going on with the clients in the client's world from a 30,000 foot view. So they're going to be talking about education planning, retirement planning, estate planning, insurance, the whole 9 yards. And that person is going to be the one that is actually putting together that roadmap for you. So basically take you where you are today to where all your financial goals are in the future. So you could have two financial advisors and you can meet with both of them. They could be entirely different, right?
Okay.
And that makes it a little bit difficult for somebody, because you can meet with somebody that calls themselves a financial advisor, and they're the ones that are maybe just managing their money, and they're the ones that are telling them which investment philosophy to go with and kind of strategize that account specifically. But they may not necessarily look at everything from a financial planning standpoint. You could have the other advisor that does all those things as well, but they also add in the financial planning. So they're talking about how much money you should save on a monthly basis. They're talking about budgeting. They're talking about everything there. So with the financial planner and financial advisor, it's important for somebody to know what they're looking for in terms of what exactly the advice that they're trying to seek. And then that'll kind of help them as they're researching financial advisors or financial planners. They can kind of decide which level of service that they're looking for. So the certified financial planner is essentially very similar to like what a CPA is for personal income taxes. Basically just lets the general public know that if you're working with a CFP, that person has gone above and beyond with education requirements, ethic committee reviews from the CFP board, just giving them another level of comfort there.
Okay. So that I have so many questions now.
Yeah.
Okay. But first, so just to clarify the difference between a financial advisor and a CFP. So would an example of a financial advisor be somebody like, if I went to, not to call anybody out specifically, but like if I went to a Fidelity who is
Sure.
known for doing retirement accounts and things like that, would that be more of a financial advisor compared to a CFP? Because I don't think that Fidelity does like insurance, estate planning, all of that. They probably have contacts, but
Sure.
Is that kind of the right way to explain it?
Yeah, and this is where it's tricky, right? So you could actually have an advisor at Fidelity that is a CFP.
Okay.
And maybe depending on how they're set up with Fidelity is maybe they only want to focus on your investments. So
Okay.
Fidelity in general and kind of similar to other firms, they may have the capability of offering financial planning to somebody, but that specific individual may not be skilled or maybe that's not their focus or area of
Gotcha.
expertise. Very similar to real estate, right? Maybe
Yes.
if you're working with a real estate agent, maybe they have the capability of doing real estate rentals for somebody. Maybe they're just looking at a normal house. Maybe you have a real estate agent that is working with developers. And so maybe you're a developer and you want to seek out that specific individual. So with Fidelity in general, or any financial advisor, it's not necessarily the firm that you're working with. It's more of that specific individual, and just having that conversation and asking questions of what they're actually going to be working on with you.
Okay, that makes sense. All right, so I guess my biggest question, and what I think a lot of people think, I remember when I was just out of college, I would have never thought to have a financial advisor in any capacity, because I'm like, I have no money, I have student debt, I don't own a house, I don't have kids, I don't need any of this.
Sure.
So can we talk a little bit about, when does it make sense for somebody to seek that financial planning? Because I know there can be a point where, I don't want to say it's too late, but you may have missed some opportunities. So what are some key things to think about, to ask yourself, like, should I hire somebody to be my financial planner or financial advisor?
Sure. No, and that's a great question. So it's never too early, like you said, to start working with somebody. The sooner that you start working with someone, of course, is going to make your life a lot easier down the road in terms of how much money you need to save to get to those goals in the future. Yeah. Also, to your point, the earlier you start working with someone, you can kind of prevent those pitfalls and some common financial mistakes that somebody can end up making by not having that person there holding their hand and walking them through and making decisions with them. So it's never too early to start working with someone. On the flip side, if you're not currently working with someone, some common triggers I would say that would make somebody kind of think about looking for some advice would be if you find yourself asking yourself some questions like, am I saving enough? Am I doing enough? I'm making a decent living. I'm putting all this money away in the 401k. I have a decent amount of savings, but where is it taking me, right?
Yeah.
When can I retire? What happens to my family if something happens to me tomorrow, right? Is my surviving spouse going to be okay? Are they going to be forced to call you up and sell the house? Yeah. There's a lot of instances there. So I would say if somebody starts to realize that they're asking themselves those questions in their head, it's probably the right time to reach out to somebody.
Man, I really should have reached out a long time ago. No, that's really helpful. So can you talk to us a little bit about, like, what does that look like? Say I'm 28, can't you tell? And I'm starting to go through that process, and I'm saying like, hey, yeah, I'm like maxing out my 401k or whatever, and I want to buy a house, and I want to go on vacation, and I don't really know what I should be doing. What does that look like? What does sort of the process look like when somebody says, hey, I have no idea what I'm doing, I need some help? How can we work together? Yeah,
no, absolutely. And that's a great question. I think that's the biggest stumbling block for a lot of people, is that finance is so personal, and it's hard to talk about with somebody, especially let alone a stranger, right? So you're getting very personal with that person. But I think in terms of, and I can't speak to every advisor out there because everyone's got a little bit different process, but a typical process with working with an advisor like myself is that first meeting is just a sit down conversation. It's a very laid back conversation, kind of like similar to what you and I are having right now. And it's just a chance for the advisor to learn more about that client or potential client situation, what they're looking for help with, what questions they have, what are some things that are important to them in their own lives, what are some concerns that they have as well. And then really it's also a chance for that person to ask the advisor questions. So back to the original conversation we were talking about and finding that right person, right? That's a chance for that potential client to ask the advisor, what are you going to be helping me with? Learn about their practice, how they operate with clients, the different services they offer. And really that meeting is just a very laid back conversation, and it's a chance for both of them to figure out if they're going to be, good working together. Yeah. You want to feel comfortable with that person. So really that's kind of the first step. It's just to do your research. And I always recommend people, they reach out to multiple different people. So, have 3 or 4 different advisors, go out, sit down with them, make sure you feel comfortable, you're asking the right questions. And then from there, if you feel comfortable working with that advisor, it really, the next couple meetings are going to get a lot deeper into your financials, looking at tax returns and things like that. But that's the first step, is just to make the call, schedule with somebody and just have that conversation.
Okay. Are there things, like top 3 questions or something that someone should kind of prepare for before that initial meeting to help make it a little more productive and help them identify whether it's a good fit? Yeah.
So 3 questions that are common that I've gotten asked before with potential clients meeting me is, what are your fees? So it's always important for the client to know exactly what they're paying for, and there's no surprises there. So you have to be fully transparent with the client, make sure they know exactly what they're getting. What are the services? So fees, services, and then the background of the advisor as well. If you want to add a couple more questions, what is your experience with clients like myself? How many clients do you have? Those type of questions. For example, if you're a physician and you have a unique financial background with your specific situation and you're meeting with an advisor that's never worked with a physician before, there's some nuances there, right? So you want to kind of ask what their experience has been with people similar to yourself.
Okay, that makes sense. Yeah, I know being in real estate, it's very nuanced as well. So having somebody who understands what it's like to be essentially self-employed and what the key drivers are in sort of that income stream is very helpful. Okay, so what are some of the, I think, that's helpful to understand if I'm preparing to go in to meet with somebody, things to think about and ask questions. What do you think are some of the common I don't know what to call them, things that people are most surprised about, or that you see people say, oh, I wish I would have known this sooner, when you first meet with people?
Sure. In their own lives, are you asking?
Yeah, in their own lives, yeah.
So I think one of the things is just the fear of the unknown.
Yeah.
So for example, going back to the original question about when is the right time to meet with somebody? So I think the biggest shocker, and it's two different things. So one thing that I've seen that kind of shocks people is they realize that they're not as bad as they think they are. People might come in with a lot of uncertainty and they're very anxious financially, but when they after they sit down and they start to see where they are today and kind of where that's taking them in the future, sometimes they walk away feeling a lot better. And it's just kind of that hand holding to reassure them, hey, this is what you've done so far, and it's not as bad as you think, and here's what your future looks like, and it doesn't look that bad. So I think that's one of the things that I've seen shock people in a good way. On the other end, shocking in the bad way is never a good thing either. But when they come in, maybe they think they're doing well and they saved enough, and then we go through some plan and we see what their future looks like. It may not look as rosy to them as they thought, which is okay. We just have to make some changes, and that's why they're meeting with someone. So I think that is also shocking in a sense.
Yeah. No, I mean, I definitely feel that. I mean, it took me so long to start working with somebody because it's very personal, and you're like, oh my gosh, I'm not doing as well as I should. I don't want somebody to see that.
Yeah.
And I would say I experienced that where it was, they were saying like, no, actually you're doing really well. And I remember having the conversation. I was like, you're not just going to tell me everything's good when it's not, right? They're like, oh no, don't worry. We're going to blow this up in a minute. Because then when you do like age predictions and all of that and what it is that you want to spend your money on, I was like, I'd like a beach house, maybe 3. It's like, okay, well, maybe that's not realistic,? And so I think that's helpful, to sort of keep in perspective. Because I was like very focused initially on like, what are the must-haves, the necessities. But I think then thinking about like, what do I really want my life to look like? And you know what? It might not happen, but at least let's throw it out there and see, because you don't know.
Yeah. And I think that's also a problem that people have is people talk, right? Friends talk. They always talk about how much money they have. And what happens is people start hearing about everyone else's finances, right? And how much money everyone else has in their own investments when they retire. And they start to think that that's a benchmark that they should have for their own lives. What people don't understand is that everybody has a different number in mind. So for example, you and I are going to have different numbers in retirement. Person down the road, your best friends, they're all going to have different numbers. So if you hear that your friend has $1 million in retirement and you look at yourself and you have 500,000, you're going to immediately think you don't have enough.
Yeah.
But what people don't realize is everybody has different lifestyles. So what that person that has $1 million, maybe they have a couple beach houses on, in retirement. Maybe they want to travel more. Maybe they want to go to Europe and have a couple of investment properties there as well. So they need more money.
Yeah.
Somebody that's, doesn't see themselves moving, they just kind of live in steady Eddie. They're just on their porch having a good time in retirement. They're visiting grandkids. They don't need $1 million. Maybe they need a little bit less. So I think that's one of the things that people get into trouble with is they start having these false realities by hearing other people.
Yeah. And I remember even just, my first few years out of college, also seeing how other people lived their life. And I just remember thinking, how can they afford that? Like, I think they make the same amount of money as me. And you quickly learn, oh, well, they've got credit card debt, or they have all these other things, or, whatever the situation is. So I think that's a really good point, is just really, you can't compare one situation to another.
No, and the most important thing is just to figure out what your lifestyle is going to look like.
Yeah.
And then what I typically do with clients on that first few meetings when they become clients on the planning process is the very first thing we do is we just say, okay, let's just take a look at what you're doing right now. So all of your current savings, your income, everything you have saved up till today, let's assume that nothing changes for the next 5, 10, 15, 20 years. And let's see where that gets you, right? What age does that take you? When can you retire? And here's exactly how much money you can retire off of each month. And if that looks good, you're on track. We can make some tweaks there. If that's not what you envision your retirement to be, then we know exactly what we need to do. Maybe we need to increase your 401k contributions. Maybe we need to downsize on the home so we can increase some savings there. Maybe we need to buy a home if we're currently renting, things like that to build some equity. It's really just, everyone's got their own, each individual financial plan that it's hard to compare to other people because it's so different.
Yeah, that makes a lot of sense. So once somebody starts working with you and you have this you come up with the plan, what is the sort of regular cadence for how often should we review the plan?
Yeah.
And what are some things that would be a trigger that, hey, we should probably reevaluate?
Yeah. So typically, and it's going to depend on what level of service that you're working with the advisor. But for me, typically a planning client is going to meet at least quarterly, every quarter. The reason why that is we kind of cover different topics every quarter. So for example, the beginning of the year, it's kind of the goal planning part of the year. So you have all your goals that you want to accomplish that year. The end of the year, for example, is all the tax stuff, right? So taxes are coming due, figuring out if there's any way we can lower your taxes and things like that. So as we periodically meet, there's different topics that we're going to be going over, but also it's a chance for us to check in on how your investments are doing. So how is your 401k performing for the quarter? Here's kind of what our expectations are for the economy for the rest of the year. Here's some changes we might want to make. Then also always keeping track on the plan, right? So if one of the things that we set aside for you in terms of getting on track for the plan was to save X amount a month and keep your budget in track, we're going to be checking that every quarter, right? And that's never a fun conversation, but it is something that is important because that's how you get to where you want to be. You got to stay disciplined. So it's things like that we always check in on, and some triggers that might cause a meeting sooner. For example, let's say one of my clients called you up and they're ready to sell their house, and now they have a big chunk of money that's sitting there. That's obviously going to change the plan. Another thing could be any life event. So whether they got a new job, maybe they got fired and they're relocating, maybe they're pregnant and expecting. All those things are obviously going to change the impact of the plan. So anytime any of that happens, typically the advisor is the first person that they want to call.
Okay. And so it sounds like there's probably a whole team of people that really need to be connected to you. Like you mentioned, end of year is tax season. And being a former CPA, well, I guess I'm still a CPA, but former tax practitioner, I wasn't providing financial advice. So do you work with, say, attorneys, CPAs? Like, who are all of the people that are part of that team for a client? Yeah,
so we don't have anybody in-house at the office, of course, that does that internally, but we are very, very close with those professionals. And it's important for the client too, because if I know what the client needs to be doing from a financial planning standpoint, and they're working with an accountant and me and the accountant are on the same page, that's never a good situation, right? If the accountant's telling them they need to save X into this type of account, but based off the plan, we have them saving in a different type of account. There's a lot of things that can not necessarily go wrong, but we all need to be on the same page. So getting in contact with their accountant, their estate planning attorney, making sure that all their wills are aligning with all their investment accounts. So for example, if somebody has a family trust and they've worked with an attorney to set that up, and that's where they want all their accounts to go, but their investment accounts that they have with me, if I don't know about a trust and their beneficiaries are just listed as somebody else and not the trust, big issue, right? So we have to make sure that everybody's on the same page. So we always recommend while we're going through the financial planning process is that we either one, have the contacts of those people that they're working with currently, and then realtors, of course, is another one. And if we don't have a contact with them, if they're not currently working with someone, we have some professionals in our network that we've referred people to and we've worked with in the past that we can always recommend too. But it is very important to kind of get everybody on the same page. Okay, that makes a lot of sense.
So you mentioned that maybe one of the things to talk about is if you're renting, buying. And obviously that's near and dear to my heart because I strongly believe that well, wealth is created when you buy real estate, even though that is your home, and it provides something else. But it also, I think, as we've seen the last 2 years, home price appreciation going crazy, and it is sort of a forced savings. But I'm curious from a financial planning perspective, like, how do you view that? Especially, like, I have these buy versus rent conversations all the time, and from my perspective, just from I know the costs of maintaining a home and the cost of selling a home and buying a home, I try to tell people, what is your plan? How long do you plan to be there? Because usually if you plan to be there less than 3 years, I'm like, it's probably not the best idea for you to buy. And so really having those conversations, but that's just more from me, from a realtor's perspective. So I would love to know kind of how you think about it and how you advise people from a rent versus buy.
Yeah, and it's a great question. I get it a lot, obviously, with clients, and we're talking about different financial planning scenarios in their lives. It's very similar to the buy versus lease on a car. It's very similar conversation. And there's no right or wrong answer. I can say that. Everyone's got their own financial situations. Everyone's got their pros and cons and their own financial goals. So this isn't a recommendation or anything like that, of course. But what I can say is, for example, if I'm working with a client, and very similar to what you said, where they're not planning on moving anytime soon. They kind of love where they live. They kind of want to grow those roots there. They have a decent amount of income coming in, so they can afford those mortgage payments. And they have enough saved up on the side for a down payment, of course, as well. Excuse me. I think that's a great opportunity for somebody to buy that longer term investment to get into a home. On the flip side, let's say one of my clients, based off their income, they may not have a down payment saved up, or maybe they're having trouble saving up for a down payment, or they have enough saved up for a down payment, but their job's pretty uncertain. Maybe they don't love the area that they live in. Maybe they're planning on maybe moving in a year or two. It's probably not wise for that person to purchase something and then end up moving 12 months later. It just kind of all depends on that specific individual's scenario and their financial situation and kind of what they're going through at that time.
Yeah, no, that makes a lot of sense. And that's what I try to think about too. I'm not here to sell you a house. I want to understand, like, what are your goals and what are you trying to do? But obviously I'm missing part of the picture too. I just can talk to somebody about their goals. I don't really know what their detailed financials look like. So yeah, that's helpful. So we are coming off of, a period of time where a lot of people have been buying investment properties. And people have different opinions about it. I have my own opinions, which I'm not even really sure. It changes sometimes. How do you feel about real estate as part of an investment strategy? Like, and I don't mean necessarily investing in a REIT where it's just there, you are just, it's like a stock or anything else, but in terms of buying properties, renting them, and whether you handle that or you have a property manager or whatever, I think there's a lot of different opinions about it, but just curious, how do you think that fits into somebody's financial plan?
Yeah, and that's another great question. And again, it all depends on that individual specific situation, and it's not advice by any means. But I would say for my clients, I want them to have a diversified portfolio, right? I want them to be invested into several different sectors, whether that be large cap stocks, bonds, fixed income, gold, energy, all the different sectors out there.
Yeah.
And the idea behind that is you never want all of your eggs in one basket. So for example, as we go through different economic cycles, ups and downs, there's going to be times where certain assets and certain sectors of that client's overall net worth are going to do really well. And at the same time, there's going to be sectors that are doing very bad. That's designed on purpose because we want to kind of even out the ebbs and flows throughout the next 10 plus 20 years. And real estate is a piece that we would use for certain clients that make sense to them, that would kind of help diversify that. And to your point, physical real estate as opposed to a REIT or something like that, of course, fits in that pot of diversifying the overall assets there.
Okay, gotcha. Yeah, because I hear people all the time talking about it. There's definitely been a lot of institutional, investors buying, physical real estate lately. And so, I'm just curious how that's going to play out, over the years to come. But yeah, I mean, there are some people who just really push, you have to have multiple streams of income, and real estate being one of them. And while that makes sense to me, and also just my knowledge of, again, the cycles of real estate and how that has played out over history, I'm like, yeah, that makes sense. But when you then think about, but I have to have all of these other things and I have to pay for my current expenses and my living,
Sure.
it gets a little hard. And I think sometimes we get lost in the media because you hear just a very siloed, recommendation, and it's really hard to understand. And so I guess my question is really, if somebody has an interest in that, is that something that, they should bring up to you at your meeting to be like, hey, at some point, maybe it's not today or whatever, but this is something I've thought about and I'd like to see how it can be incorporated into my plan. Is that how you recommend it? Or is there times where you would say, hey, maybe in conjunction with the CPA for sort of tax reasons, hey, you might want to think about investing in this for whatever reason?
Yeah, absolutely, and that's actually something that comes up pretty frequently when we're doing retirement planning. I always kind of stick back to the base plan, so I call it the worst case scenario. Here's what you're doing. Here's kind of what our track is, and here's where it's going to take you.
Yeah.
Obviously, things will improve or make worse as you go through different life changes. So things are going to change at all times, but we kind of have a worst case baseline plan there. One of the things that we can do is, when we talk with clients when they bring that question up, is we can model that into the plan. So we say, okay, let's say we got a rental property, right? Let's say we got that investment property and we're now spitting off some income. We can show the client exactly what that income looks like when they're whatever retirement age is that they're planning on, and we can toggle that on and off. So we can say, okay, here's what your scenario looks like without the income.
Yeah.
Here's what it looks like with the income, and there's pros and cons to everything, right? There's tax implications. There's to get that investment property, you have to come up with the down payment somewhere. But that's definitely a question that should be brought up with your advisor or financial planner, because it will impact the plan in a good or bad way. Just depends on how they set that up. But it is something very important.
Yeah. I think sometimes people just think about that as being like sort of an ancillary thing and not necessarily part of the overall financial plan. So that's helpful. What do you think, like, what is it that I haven't asked you? Like, what is it that you would love for other people to know, or questions you think people should think about, whether they're ready to hire a financial advisor or not? But like, what are the things that you're like, if I could just get somebody to think about this, or, anything really, like, I don't know what I don't know. So enlighten us, please.
Yeah, no, I think the most important thing is just taking that first step. So whether you're somebody that's been kind of, going back and forth on whether they should seek help or not for the past several years, just do it. Make the phone call, sit down with somebody, and just have that initial conversation. See if that person's the right fit for you. Make sure you feel comfortable with them. Get the advice. Even, there's been so many times where people have come in on the flip side where they think they're okay and they think they're pretty confident with what they're doing, and they might be. But there's little things that the advisor typically can add value to. So even if you think you're okay with retiring at XYZ off of, let's just say you plan on retiring at age 65 off of X amount a month each month. You very well might do that. But what they're not thinking about is, can we improve that? Can I retire earlier? Can I live off of more each month? There's so many things out there that the general public doesn't think about, that they should probably be sitting down with somebody just to help guide them, even if it's just a second opinion at that point. Just helping them make sure that they can sleep better at night. They don't have to feel anxious about their future. It's just the most important thing is to sit down with somebody and make the call.
Awesome. That's great advice. What do you think are, I don't know how many, like, what are the most common, I would say, goals or challenges that you think people come to you with right now?
Right now. So it's a good question. So obviously where we're at with the economy and the stock market being down for the year, a lot of people start to panic. And there's a very good reason for it. There's a lot of negative news. There's a lot of negativity in the news nowadays with everything going on in the world and the economic as a whole, or the economy as a whole. That's even more important now is more important than ever, that you should reach out to somebody if you haven't before, because again, you might think that your portfolios are down, or 20 or 30% and your 401k is down and everything looks doomy and gloomy, right? But if you work with somebody, you might find out that it's not as bad as it looks, and it might actually prevent you from making a mistake that will cost you for many, many years to come.
Okay. Okay, awesome. All right, so tell me about annuities. So they, I have heard good and bad about annuities, and I'm just kind of curious. I don't even know exactly what to ask. There are people, I think it's an insurance product, right? And so, it can be, hey, put your retirement essentially in this, you buy this annuity, and we're going to limit your loss exposure. And that can sound really exciting to somebody. But I guess like it seems too good to be true. And not to say that they're bad, but I guess can you just maybe give us a high level of annuities and when you think they make sense?
Sure. And I think all the negativity about annuities comes from back in the day when they first were brought out in the industry. Back in the day, it was a common theme where if a client walked into an advisor's office, they were leaving with an annuity whether they needed one or not. That's why they kind of have the bad rap, is because a lot of people were sold those back in the day, and they may not have necessarily needed one.
Yeah.
So to your point, annuities are good and bad. And it all depends on the client. So for example, if somebody is very risk adverse, they want some growth on their account, but again, they want some limitations to the losses in the stock market, they may be willing to pay a higher fee annually every year to that insurance company to give them that sort of level of comfort. So basically, in general, what an annuity is it basically takes your investment account, gives you some protection on the downside, but it kind of limits your exposure to the upsides as well.
Okay.
So they basically will say, I'm just going to use an example. Let's say you had a $100,000 account. They're going to take your $100,000 account and they're going to figure out behind the scenes as an insurance company, they have all their formulas with actuaries and everything. And they're going to say, we're going to promise you $100 a month every single year as long as you're living, even if the stock market went to zero. For some people, that level of certainty is all they need.
Okay. And
they don't want to worry about all the ups and downs. So if they look at their account and their account's down 50%, that person doesn't have to worry about it because they're still getting that monthly guarantee. So for some people, if they need that income gap in retirement and they want that certainty, it kind of turns into a pension at that point.
Yeah.
So that may make sense for them. On the other hand, if somebody is more risky as an investor, they're okay going up and down with the stock market, and they don't necessarily need to supplement that guaranteed income from a monthly basis. Maybe they have a lot of savings in retirement. It may not make sense for that person to pay that insurance company such a higher fee to get that certainty of guarantee. So there's pros and cons.
Yeah.
It just kind of depends on the client. The reason why they have a bad reputation is because they were oversold back in the day. But it's not to say that they're a bad thing. It just depends on if that client truly needs something like that.
Okay, got it. Yeah, and so I think this, you've used the term risk a little bit, which I know is what you deal with day in and day out. Can we talk a little bit about what risk is at different stages of life? Because if you, like when you were just explaining about the annuity and I'm like, oh yeah, no, I don't want risk. But at the same time, because I have some experience with this, I'm like, no, actually I'm okay with some risk but the word sounds so scary.
Sure.
And so can we talk a little bit about like what risk truly is? And, are there points in time where paying attention to your level of risk is more important?
Sure. And that's a great question. So typically anytime we're talking about risk, I use the analogy as it's how fast you're getting to your financial goals. So the riskier you are, the faster you're going to get to your goals. But think of it being in a car. Now you're driving 120 miles per hour. Every little bump in the road, you're going to be flying through the roof, right?
Yeah.
There's a lot of ups and downs there. The slower you're driving on that bumpy road, obviously you're going to take a lot longer to get to your goals, but it's going to be a much smoother ride. So that's kind of how risk works within the stock market. And it kind of comes down to two things. So the first thing is whatever that financial goal is, how much time do you have to invest? So for example, if we're trying to save for a down payment on a house, and let's say that's 2 years away, we don't have a whole lot of time to get into the markets and have all the ups and downs, because if we get into the markets at a time, like they are right now, when the markets are down 30%, you don't have enough time for it to come back up to get your down payment money. So one, you have to have enough time on your hand to invest in the stock market. So if we're talking about retirement, you got 10, 15, 20 years, you can afford to be a little bit risky.
Okay.
The second thing would be what your personal comfort level of risk is.
Okay.
So for example, even if you have 20 plus years to retire, you can afford to take risk. If you're not personally comfortable looking at your account statement and seeing your account down 20% and vomiting all over the table, probably shouldn't be invested that risky. So you kind of have to balance those two. One, you have to make sure you have enough time, and then two, you have to figure out what that right comfort level of risk is for that account. And that's when working with an advisor can kind of walk you through what those numbers look like, give you some examples of, based off your portfolio, here's what you could expect your account to be down versus being up. And you're really just trying to find that comfort level there.
Okay. Okay. And so is there sort of a minimum, like, would you say, if you are planning to retire in 10 years, is that a point in time when you would say, okay, we should probably talk about that and reevaluate risk tolerance? Is there a period of time where, I know there's, the stock market is like the real estate market, and it
Sure.
has, seasons to it, and we have history on our side to be able to at least look at it, even though that's no guarantee. Is it a 10-year cycle, or is there anything scientific to think about, like how many years before you want to retire that you should start thinking about that?
Yeah, and that's another great question. So typically what we try to do is, when you're getting close to that 10-year mark, so let's just say, for an example, a client was a more risky portfolio, and they're 10, 15, 20 years out from retirement. So let's just say that's a 80% stock portfolio, which just basically means you're pretty risky. You have a lot of risk in the stock market. As you get in that 10-year mark or under, so as you start approaching like the 5-year mark, that's typically when you want to start flipping the script on the risk tolerance level. So for example, if you are 60% invested into stocks and 40% invested into bonds, which is a little bit more conservative there, once you're about five or less years, you kind of want to flip that. So as you get closer to your benchmark, whatever that goal is, whether that be saving for a down payment, maybe it's kids' education, maybe it's your own retirement. Once you're in that 5 to 10 range, that's typically when you start making the switch. And as you get closer to that goal, once you're in that 5+ range, or 5 years or less, that's when you want to completely switch it to you're much more conservative.
Okay.
Anything between 5 and 10, you can still afford to be a little bit more risky.
Okay.
Over 10, you have plenty of time there on your side. You can be more risky. But once you start getting 10 and under, that's when you start thinking about rescaling things back a little bit.
Okay. So you said something that, about kids and retirement and all of these things. There are so many things, like buying a house, that I never would have thought, oh, I should talk to somebody about this and about how to plan for that and buy a house. Or, I don't have kids, but, the same thing, like, I was like, oh, when I have kids, I'm gonna have to worry about a 529 plan. What are sort of some of those major milestones that people generally should be thinking about planning for, where working with you would actually help them, and you could actually have somebody who's qualified, other than your uncle who has his own opinions about things, on the best way to sort of manage those affairs? Like, what are those key things other than planning for kids' education and retirement?
Yeah, so some common triggers is what I'd call them, right?
Okay.
So obviously, when you have a newborn or you're expecting, not only is the 529 plan important to reach out to an advisor to start setting that up and talking about how that works planning-wise for their education down the road, but also from an estate planning perspective, it's very important, right? You have to make sure that you have enough life insurance on each other there for both spouses in case something happens to you. Basically just trying to make sure that their surviving spouse has enough money to maintain their lifestyle. They don't need to sell their home. They can still take care of their kids. Maybe they move closer to family for some extra help. Also making sure that they have some general estate planning documents in line there. So power of attorneys, guardians. So a lot of people, they might have like a godmother or godfather through their church system or their religion, which is nice. However, there's no legal basis to that. A lot of people don't know that. So if they get a guardianship through their basic estate planning wills and documents there, that'll cover that.
Okay.
So kids in general is a big trigger. For multiple reasons there. The other thing would be obviously retirement. So getting your retirement plan set and make sure you're on track for your own goals there. Business owners. So if you're thinking about starting a business, there's a whole another revenue there, or a whole other avenue there that we can talk about for business owners, because they have a lot more complexity there. So they have their own retirement savings as a business to offer for their employees. They have their own personal retirement savings for their own personal finances. So making sure we can kind of walk through and again work with their accountants to make sure everyone's on the same page. That's another big trigger there. Anytime that there's a life change that happens, so whether that be a new job, now you have a promotion, more income, maybe you're relocating to a different job, so now you're got to find a broker like yourself for real estate and buy a new home. There's a lot of things there with moving or relocation of jobs. Really, anything that changes in your life is a good trigger.
Okay. All right. Well, this has been really helpful, and hopefully all of our viewers find it helpful too. Any closing thoughts that you want to leave us with?
Stay on course. So the biggest thing with everything going on right now with the economy, if you're already working with an advisor and you have a plan set in place, don't let what's happening right now scare you. Make sure you're working with that advisor. You're asking questions. If you're supposed to be doing X, Y, Z for your plan, don't let what's happening right now change that.
Okay.
This typically is something that people are already planning for on the planning side. So we're already expecting us to go through economic cycles like we're living in right now. So don't change the course. Don't sell everything and make mistakes that'll cost you down the road. If you haven't worked with somebody before, definitely feel free to reach out to somebody. Have that initial conversation. Just take all your financial anxiety away.
Yeah.
Just have a conversation. Even if you don't end up working with that person, you'll just most likely you'll feel better leaving that conversation because you let it all out.
Yeah.
Talking through your concerns, hearing about where you're at financially and things like that.
Awesome. Well, thanks so much, TJ. That's very helpful advice, especially the staying on course, during this time of the market. If somebody is interested in scheduling a consultation with you or working with you, what is the best way for them to get in touch with you?
Yeah, absolutely. So I can be reached via phone, and that's 704-703-2125. You can go to my website, which is tjfaber.com. All my contact information will be there as well.